think, act, and prosper. You are now tuned into the Money Level Show.
Hey, Rick, what's been happening?
Well, life has been good, Daryl. Resource markets have begun to pick up. That's bad in the sense that things aren't as cheap as they were 6 months ago. But in fact, it heartens a lot of participants to see a bid for the stuff they've been holding. We talked before about how the junior silver stocks were a very hated asset class. They're uniformly up 25 or 30%. It's nice that you and I were on the right side of an issue, and to see the market respond so quickly. And of course, the uranium sector is on fire again, too. So really across the investment landscape, while it's probably early on in the recovery for natural resources, you and I aren't quite in as orphaned a position as we were the last time we visited.
Mm-hmm. Yeah, I actually, I got kind of shaken out of the junior silver stocks, but I was holding on to some of the majors, more of the majors, but
Good.
it was really that volatility was hard to stomach, during that time, and then now they're up significantly. I'm like, no.
Well, we'll work with you on volatility, Daryl. It takes some time. You're a young man, at least compared to me. And what you learn is that these moves that are gut-wrenching are only gut-wrenching for a little while. If you think through them, they become less problematic. But it does take time to become sanguine to markets that move 10 or 12% up or down for no particular reason, day by day by day. Developing patience in the face of that is an acquired skill. But hopefully, with you and your listeners, over time, these discussions will help.
Yeah, for sure. And I mean, obviously, the uranium market's picking up. I'm still holding there, and that's been feeling pretty nice in the account. So before we get into resources, I wanted to get your just your take on where we're at. Where do you think we are at in this kind of macro environment? We have the Fed maybe pivoting on rate cuts. Inflation's still staying pretty sticky. What's your assessment of the economy right now?
Well, we have an interesting economy. For folks like me, old, fat, bald, rich guys, the economy is working really well. I'm surprised, frankly, that the economy is, at least in terms of the headline numbers, as strong as it is. Reported unemployment is fairly low. Now, that's partly a function of people who aren't as lucky as me having to have two jobs. That number disguises the fact that the economy isn't working for millions and millions and millions of folks. Artificially low interest rates. So I understand that interest rates are higher than they were 3 years ago, but I still believe that the interest rates are controlled by the Fed, among others. My belief is that if you had a free market in interest rates, they'd be 250 or 300 basis points higher. Make no mistake that artificially low interest rates benefit rich people. They benefit folks like me because I have access to credit, which many people don't have. And I have access to opportunity to deploy credit. Normal folks are getting deprived of interest income on their savings. So low interest rates are in effect an income transfer from working folks who save what they can to rich folks like me who utilize those savings at an artificially low rate and are able to redeploy them. So for me, this economy is working spectacularly well. But the truth is that it's not working for an increasingly large number of Americans. Unfortunately, those Americans are looking to government for the solution, when government is, of course, the problem. With specific regards to the direction of interest rates, as you know, Daryl, I'm in the process of starting a new bank. And as a consequence, I'm in discussion with several of the lower ranking employees at the Fed. I need to report, interestingly, that these are high quality people, which is not what I had anticipated. And at the Fed, I think the institutional bias is that the Fed itself is the only arm of government that stands between the US dollar and catastrophe. The Fed sees the Congress and the president as having no interest in reducing spending and no interest in controlling the debt and deficit. And the only tool in the Fed's arsenal is to keep the interest rate as high as they can get away with. Now, my suspicion is that because many people believe lower interest rates stimulate the economy, and because this is an election year, that the political pressure on the upper levels of the Fed is probably unsustainably high, which means that the Fed will be pressured, perhaps successfully, to lower the interest rate. If that happens, what that signals is that the administration, and by the administration, I don't just mean the Democrats, I mean the Democrats and the Republicans, are more concerned about getting reelected than they are about the health of the economy and inflation. And if they capitulate with regards to the interest rate, I think that you will see interest-sensitive investments, including in particular gold, react, and probably react violently, the same way that they reacted at the end of 1975, the last time that there was a major Fed capitulation in the face of inflation. I hope that answers the question.
Yeah, for sure. So let's say gold does, react in this way. I mean, gold's staying very resilient in the midst of high interest rates, and we've been seeing like the Shanghai exchange and China buying a lot of gold, and so could you explain what is happening there? I'm hearing about it. I've read a little bit about it, but it seems like there's this discrepancy in the price measured in dollars between the two different exchanges, between the Shanghai and I think it's the COMEX.
Yep. The Shanghai exchange is effectively destocked, which is to say that the float, the inventory, has been bought by private citizenry and by the Chinese central bank. It's important to note that the move in the gold price, Daryl, that we've seen in the last 2 years, 2.5 years, from $1,800 to $2,300, has been accomplished without retail buying in the West. If you look at the statistics of the physical gold-related ETFs, what you will see is that Western retail buyers, European and North American retail buyers, have been selling for 2.5 years, while foreign central banks have been the buyers. There is retail buying of gold in China, in Korea, in Taiwan, and in India. But the primary drivers of the gold trade have been foreign central banks. They've been doing it, I think, not so much in protest to U.S. fiscal policies, although partially that has been true, but rather because of the weaponization of the U.S. dollar. Whether or not you agree with U.S. foreign policy, the decision to confiscate $300 billion worth of Russian holdings of U.S. treasuries has caused other foreign governments whose relationship with the United States is occasionally called into question to wonder whether they should hold U.S. treasuries. In particular, that causes some disquiet to the Chinese, who are large holders of treasuries, and has caused them to begin the process of selling their U.S. treasuries and buying gold. I would suspect, too, the second challenge for foreign holders of the U.S. Treasury has simply been the arithmetic. The U.S. government absolutely promises to pay you 4.3% a year for 10 years on your U.S. Treasuries, and they will, even if they have to print it. But I would argue that that currency is losing purchasing power at 7 or 7.5% compounded. I know the government tells you it's 2.6 or 2.7 in the CPI, but I would argue that any rational human being or any rational government that looks at the increase in food prices, looks at the increase in energy prices, looks at the increase in manufactured goods prices, looks at the increase in construction costs, would understand that the real deterioration in the purchasing power of the US dollar is more like 7.5%. So on the Treasury, which the government is asking these foreign governments to buy, they're paying them 4.3 in a currency where their purchasing power is declining by 7.5. In other words, they're losing 4% of their purchasing power compounded every year for 10 years. In addition to the fact that they're afraid of the US government, that makes it a lousy investment. And I suspect that that same realization will hit true for Americans. Think about your own income statement and balance sheet, Daryl. Think about whether the basket of goods and services that the Thomas family consumes on an annual basis is actually rising in price only 2.6 or 2.7%. Ask yourself what's happened to your gasoline bill in the last 4 years. Ask yourself what's happened to the clothes, the price of the clothes that you buy for your son. Ask yourself what has happened at the checkout counter in the grocery store over the last 4 years. And ask yourself whether your cost of living has actually gone up 2.6% a year or some higher number. And when you arrive at that higher number, subtract the 4.3% that the Treasury purports to pay you for a U.S. 10-year Treasury, and tell me whether or not that seems like a good investment to you. If the answer for you is the same as the answer for me, which is to say no, you need to begin to do something about it.
Yeah. Yeah. I mean, just you painting that picture and me just putting myself in that visual state of my own balance sheet and our bills and everything. I mean, over the last 4 years, I've had to, work really hard to increase my income significantly.
Right.
And so not saying that people shouldn't do that regardless, but that was definitely a major factor in terms of, you're seeing the cost of your living increase, and you're like, okay, either I'm going to be screwed or I need to get out here and work harder to increase my income even more. And so that's definitely been a factor that has played out within our family household.
And let's say, Daryl, that you paid attention to that interview that you and I did about the mindsets of the rich. And let's say that you went out and you generated more utility. In other words, you earned more money than you spent. The delta between what you earned and what you spent is your savings, and you invest your savings. It's a real shame if you do the right work to generate more wealth than you consume, and then you lose the surplus. Bad investments. Let's say that you go out and let's say that you're able to save $1,000 a month, $10,000 a year. And then you put that $10,000 a year into something that costs you 3 or 4% a year in purchasing power. That's a tragedy. And Americans who don't understand the arithmetic of what's happening to them are committing that sin every month. Now, there are other Americans that are creating other sins, which is to say they aren't trying to get solvent, but they're trying to live rich, which is to say that their household expenses exceed their household income. In that particular case, they don't get to blame the government. The real blame is much closer to home. I'm talking about those people who are doing like you. They're perceiving the problem. They're dealing with their own circumstance, not worrying too much about the world as a whole. But then, having done the right thing, they snatch defeat from the jaws of victory by either not investing or investing incorrectly.
Mm-hmm. Yeah. Agreed. So in terms of, so when we look at this, right, I mean, that's what pretty much a lot of Americans are going through right now, is whether they are concerns about their capital being sucked away by inflation, real interest rates, and also those who are living lifestyles that are above their means, because I mean it costs more to borrow now, and
Right.
and we're looking at I mean, because even for me, like I had left the job where I had a pension, and I said, "Hey, I'm taking that out because it's just gonna be earning like 2.5%." I'm like, "No, I'm not. I'm not leaving in the government's hands at 2.5%." And so, just even thinking through that, like, okay, well, when we look at like retirement, or these other dynamics to try to factor in for later on in life, like you have to have some real money. I mean, and we started off talking about gold, but that's what I feel like is the insurance, for me and my family, moving forward. Obviously, natural resources and such, but I feel like at the same time, the concerns with how much the deficits are, how much inflation is, how much, I mean, we're unfunded liabilities we have. And so all those different things, like, I'm just like really thinking like, okay, yeah, I need to keep buying gold. I mean, obviously building a business, increasing your income is important as well. But as I see, as these years just keep flying by, it just feels like it's getting more grimmer in terms of the government actually turning things around fiscally. I just don't think that that's going to happen. Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
It is grimmer. The truth is, and you just made this point, and I want your listeners to pay attention to it. The headline number is that the federal government, just the federal government, owes $34 trillion in on-balance sheet liabilities. The number that's under that is much scarier. The net present value of entitlements and obligations, Medicare, Medicaid, Social Security, military pensions, government pensions, unfunded private pensions covered by the Pension Benefit Guarantee Board, the environmental trust fund, stuff like that, just at the federal level, the net present value, not the nominal value, but the net present value of future obligations, according to the Congressional Budget Office, is handily in excess of $100 trillion. That means on-balance sheet and off-balance sheet liabilities at the federal level alone exceed $140 trillion. You think, well, that's the government's debt. But guess what their security is? It's Darrell Thomas. It's his future earnings. It's the benefits that he's come to expect, that he's going to enjoy when he becomes my age. But that's very doubtful. You need to take control of your own future, and you need to take control of it now. The idea that somebody, how old are you?
36.
Yeah, okay. So the idea that somebody's 36 is, yeah, man, I get it. There's a big problem coming when I'm 65. You wait till you're 65, you won't have dealt with it. You need to begin to quantify the problem that you're going to have to face the next 30 years, but you have to start dealing with it on a monthly basis right now. You can't postpone dealing with a problem that's substantially larger than you are. Folks your age who believe that they're going to enjoy the same rate of entitlement benefits that I do are using bad drugs. It's not going to occur. Those benefits aren't going to be there. And the political fight over how the government allocates future benefits to which classes in society are going to be ugly. And you aren't going to be able to anticipate who's going to win, how they're going to win, and what time frame they're going to win over. So you need to take control right now. You need to prepare right now to prepare yourself to earn in an economy where it becomes less easy. You need to prepare yourself right now to discipline your family with regards to their spending. Make sure they spend less than they earn. And you're going to have to discipline yourself right now to save the balance between what you make and what you spend and invest it correctly. And I would suggest, as you have suggested, that given the range of challenges that we face, that gold become part of that savings plan.
Mm-hmm. Yeah. Yeah, for sure. Yeah, it's definitely in my savings plan. I'm telling you, it's got to be there. It helps me sleep at night and everything. You can't put a price on peace of mind, huh?
And it's important, Daryl, that you're doing what you're doing. There's a lot of folks who say, I'm 35, I'm 34, I got a lot of time to work this out. Wrong. The problem's getting worse. And one of the great lessons about investing is compounding. You got to invest in a way that makes time on your side. If you compound money from age 35 on, you're going to be taken care of at age 65. But if you wait until age 62, you're going to be in a world of hurt. And the future that you face is going to be much less benign than the future that I faced at your age. Let's face it. One of the things that government does is they preside a transfer of wealth from young poor people starting out, or not poor people, but young people starting out, to old people like me. We promised ourselves all kinds of cool benefits, Social Security, Medicare, Medicaid, a whole bunch of stuff. We promised ourselves all this neat stuff, but we forgot to pay for it. We put it all in the tab, and we're giving you the tab. I hope you enjoy it. You need to decide how you're going to pay for that tab and how much of it you're going to pay for. At some point in time, we have to have a political discussion in the United States about entitlements, about who gets them, how much they get, all that kind of stuff. I have no idea how it's going to turn out, except I know it isn't going to turn out well. And that tells me, once again, the importance of the lesson that you're responsible for your future. You're responsible for your kids' future. And you got to deal with it now.
Mm-hmm. Yeah. Yes. Agreed. So, Rick, just so even thinking of other ways that we can compound, you and I, we've talked a lot about natural resources and in particular uranium. We're seeing uranium start to rise significantly again. And I wanted to see what's happening there. What are you seeing there? And I mean, it seems like we're in a long-term sustained bull market with the term market and the contracts and such. Is that like the main driver of what we're currently seeing?
Yeah, I would agree with that. I mean, I think two things. We're in a structural deficit in uranium, which is to say that uranium, among other things, has returned to some degree of political favor. And there's a realization that if we are going to preside over a world that's increasingly electrified, particularly if we're going to accommodate the needs of the billion poorest people on Earth who need electrification, that in order to do that in a way that doesn't generate too much carbon, that we're going to have to use nuclear power. And that realization has manifested itself around the world. So we're building nuclear power plants like mad, but we can't fuel the plants we have now. So we have a structural deficit. Now we'll fix this deficit. Higher prices, will fix this. And the market recognizes this. What's changed in the uranium market is the development of a term market. In most commodity businesses, prices are decided at the minute on spot. But in uranium, because of the structure of the market, producers and consumers can enter into contractual arrangements that govern the amount of uranium transacted and the price it's transacted for as much as 15 years in the future. What's useful here for the investor is that in uranium, it's the only commodity that you have a sense of what you're going to sell it for. And you can forecast top line sales, and to a lesser but still great degree, what the margin you're going to enjoy on that production is. And I think because of that while the easy money has certainly been made in uranium, the sure money will be made in the next 5 years as these contractual agreements are entered into, and as the net present value associated with those agreements is discernible by careful reading of the income statement and the balance sheet. I've never seen this occur in a commodity before, and I'm looking forward to this. In furtherance to the rest of your question, though, in terms of the allocation of savings, I think despite the fact that US dollar liquidity in deposit products costs you purchasing power, ironically, as much as 20% of your portfolio ought to be highly liquid. The reason for this is if we have a repeat of circumstances like we had in, as an example, 2008, and before that in 1997, liquidity crises, having access to liquidity in a panic is really highly advantageous. It gives you the tools and perhaps the courage to act when nobody else is acting, which is really beneficial to you in the long term. I know it sounds contradictory, but you have to maintain a reasonable degree of liquidity, even though it costs you purchasing power, in order to give you the flexibility to use a financial crisis rather than being used by it. And I think, too, that you need to own gold or gold-related securities. In addition, I think you need to own other unpopular but simple investment ideas. The easiest one of those for me to understand is oil and gas. The major oil and gas companies are making a boatload of money, and they're cheap because they're politically incorrect. So the idea that there's a savings portfolio as an example that doesn't include ExxonMobil, as boring as it is and as unpopular as it is, doesn't make any sense to me. It doesn't make any sense at all. Most importantly, Daryl, it's important to recognize that you need to make investments where time is on your side. There is a lot to be said for allocating to sector-dominating companies, the equities of sector-dominating companies during financial panics. Buffett didn't own any gold in the 1970s, last period of rampant inflation, but he made a boatload of money by investing in companies that had pricing power, by investing in companies that, because of their product and their market dominance, could raise prices faster than inflation. Because one thing that inflation does is it raises the cost of competitors to establish competing production infrastructure. So in capital-intensive businesses, what Buffett learned was to make inflation his friend, and you need to do the same thing. You need to invest in businesses where inflation makes it more difficult to compete with you, and businesses that can increase their prices faster than the rate of inflation. You do that by not having an investment horizon that's limited to the next long weekend. You need to invest in the 5-year term and the 10-year term. And you need to be comfortable doing that, because what you're trying to do, yes, you're trying to provide for your family right now, but that's what your job is for, not your investments. You're trying to provide for yourself and your children's future with your investments. And that future necessarily involves taking a much longer term perspective than you might otherwise do.
Hmm. Yeah, exactly, exactly. So there's a couple other investments that I've been looking at. I haven't fully jumped in to really understand them, but they do seem pretty cheap. Platinum and palladium. I've been wondering about that. If you have any take on those two metals. Obviously, they have huge ties with industry and automobiles, but palladium's. I mean, it's been about 50% off of when I was buying it about a couple of years ago, and so I was wondering if you had any take on those two
Well,
metals.
first of all, I'd regard those as speculations. I wouldn't use a substantial amount of money in them. I'd use an amount of money that you could afford to lose some of. I own platinum and palladium, and I own them for precisely the reason that you said. They've come off in price because the big thinkers of the world, the Bidens, the people like that, have told you that the internal combustion engine is going to go the way of the dodo in 2030, 2032. And platinum and palladium, as you know, are used as auto catalysts. They're used to make cars less smoggy. Now, the internal combustion engine didn't go anywhere till 2065, 2070. So the ongoing utilization of platinum and palladium is assured unless people want more smog, which is not a circumstance that I think is going to come to occur. What's interesting about PGMs is, first of all, one of the reasons why they're declining in price is because one of the big platinum palladium producers in the world is Russia, and Russia needs money. And like all other folks that need money, they're selling whatever they can to get their hands on that money, including their platinum and palladium. We saw this in 1990, the last time the Russians were broke. And that selling will end when it ends. Mr. Putin doesn't call me up and say, Rick, I'm going to run out of platinum in 3 months. So I don't know when it's going to happen, but it is going to happen. The other side of the equation is a speculation, is that platinum and palladium, to a large degree, are only produced in three countries: South Africa, Zimbabwe, and Russia. Now, South Africa is a basket case. Zimbabwe is worse, and Russia is none too stable either. If you had politically or socially inspired supply disruptions in particularly South Africa or Russia, I think what you'd find, and I'm not saying it's going to happen, but if it did happen, you're going to see a fairly immediate doubling of the platinum and palladium price. So I think it's a wonderful speculation. I don't think it's something that somebody should put 20% of their net worth into unless they're extraordinarily wealthy and are willing to take a shot with 20% of their net worth, in hopes of doubling their net worth. But a smaller portfolio allocation as a speculator makes absolute sense to me.
Mm-hmm. Yeah, that's good. That's good. And then copper. So we've seen copper start to turn around, and any insight there?
Your risk in copper is simply a global recession. I'm not saying we're going to have one. I'm not an economist, right? I'm a loan shark. Absent a recession, we're going to have really severe copper supply shortages in 5 years. You can have supply shortages if a recession reduces demand and still not have the price go anywhere. But if you are of the opinion that a recession's not in the offing, then you almost have to buy copper. And when I say buy copper, you don't have to buy the penny dreadfuls that are exploring for copper. You can buy the BHPs, you can buy the Freeports, you can buy the big companies that are paying very generous dividends. If you're getting paid a 6 or 7% dividend, you don't have to wait for the copper price to go up to be happy. You can be happy next quarter because you get a check. It's important that you understand that. There are a range of large copper producers that even at today's prices are making a lot of money in the copper business. And they're kind enough to return some of that money to the owners, you, by way of dividends. So I absolutely, positively would encourage your listeners that can afford to invest before they speculate in the copper business. by buying some of the largest copper producers in the world and pocket that generous dividend while they wait.
Hmm. Yeah, that's good. That's good. And then before we, I want to talk about the symposium and as well as Battle Bank before we get off, but I don't want to leave my silver bugs hanging. So I got to ask you about silver.
I think silver's on the way now. You know, silver had to wade through a lot of hate. There were a lot of folks around the silver squeeze 2020, 2021, who sort of believed that they could, with their individual efforts, change the nature of the silver market. That didn't work so well. They ran into Wall Street, and Wall Street ate them alive. And there was a lot of them. You know, there's no hate that is as severe as the hate of a jilted lover. And there was about 1 million jilted lovers on Reddit who came to really truly hate silver. But we've worked through that hate now, I think. You're seeing the silver quote start to move up. And you and I discussed on your show before for the last couple of years that in prior bull markets, gold had to move before silver did. When the momentum was established by gold, eventually it would come to silver and then to the silver equities. We're seeing all that happen. The silver stocks, be they junior or senior silver stocks, have had 2 or 3 pretty good months. It wouldn't surprise me to see them take a break. It wouldn't surprise me to see them have to stop to catch their breath. You know, that's normal and natural for resource bull markets. But if you believe, like I do, over the next 5 years, that the gold price doesn't just go higher, it goes substantially higher. And if you're a student of history, which teaches you that when the gold price moves, silver moves later, but further and faster when it moves, then speculating in silver stocks is a highly intelligent decision with an amount of money that, as you've so bitterly learned, you can tolerate the volatility around. The important thing with silver speculation is patience and nerves. Don't bet more of your net worth than you are comfortable betting. And then understand that when it makes sense to you, you may be 2 years early. 2 years seems like a long time. But if you're playing for triples and quadruples and 5 baggers and 10 years, 10 baggers, 2 years isn't a long time at all. And that's the game that you're playing in the silver stocks.
Gotcha. Okay, so you have we have an amazing symposium coming up. I'm excited to be there. Got my ticket and booked and everything. So Money Levels is going to be there. So could you share about the symposium and then also share about Battle Bank?
Sure. Let's do the symposium. First of all, I'm delighted that you are coming. I know that you came last year, so you had a chance to understand for yourself the value that we offer up to individual investors. But let me summarize that. First of all, unlike most conferences, this conference has stood the test of time. I don't know exactly because I'm too old to remember, but this may be the 30th year I've done this conference. So it wouldn't have existed for this many years if it wasn't a good product. What makes it a good product? Well, we have these great big picture thinkers, the global macro guys, the Jim Rickards, who talks about Wall Street from the perspective of the former chief counsel of long-term capital management that almost brought down Wall Street. There's nobody who understands the structure as well as somebody who almost toppled it. We have Nomi Prinz talking about Wall Street too, former analyst for Goldman Sachs. She was, in a biblical sense, in the belly of the beast. Daniela DiMartino Booth, who talks about the Fed from the same perspective. She was in the Fed. These big picture thinkers talk to you about the way the world is, not the way CNBC or ABC or President Biden wishes it was, but the way it is. After we've messed with your worldview, we tell you what to do about it. We have gold analysts and natural resource analysts who've been making money in the market for 30 or 40 years, telling you how to employ the strategy to defend yourself against the circumstance described by the macro thinkers. Much more importantly than that, Daryl, and you got to benefit from this last year. We have the living legends, entrepreneurs who have built multi-billion-dollar natural resource companies from scratch, talking about the lessons that they learned and how it makes them better investors, how it can make you a better investor too. Finally, at our conference, every exhibitor has been personally vetted by me. Every public company that exhibits there has to be owned in my accounts or accounts managed by me. Now, unfortunately, the fact that I own a stock doesn't guarantee it goes up, but it does guarantee that I've studied them well enough that I've invested my own time and treasure and reputation on them, unlike any other investment conference I know of. Whether you attend the conference live, which would be my preference, July 7th through 11th in Boca Raton, or from the comfort and convenience of your own home via live stream, if you don't believe for any reason that you didn't get your money's worth, I personally will refund your tuition. No other investment conference in the world I know of has a gold-plated money-back guarantee. Whether you attended the conference live or via live stream, if you don't believe you got your money's worth, I'll give it back. In addition, you'll have access to the recordings of the conference. And this is important because we're going to give you something between 50 and 60 hours of programming over 4 days. So, 10 to 12 hours of programming a day. And there's no way that you're going to be able to absorb all this. You were there last year. You can't do it. Having access to the recordings means that you have access to the knowledge at the conference for the rest of the year so that you can absorb it bit by bit by bit and employ it. I put on the conference last year, as you know, Daryl, and I know all these folks for a very long time. I've been studying all this stuff for almost 50 years, and I've had to play the conference recordings 3 or 4 times to gather everything. So it's important that people understand that around the conference. Once again, you can attend live, which I would prefer. It's a good party. Or you can attend at the comfort and convenience of your home via live stream. With regards to Battle Bank, that story goes back a few years. 1999, I guess it was, a group of us started a new kind of bank, a bank that didn't have branches. Our branch was your phone or your computer. Because we didn't have branches, we had about 1.5% cost savings, which we could pass on to shareholders, depositors, or borrowers. And this was a pretty successful bank. We grew it from zero when we opened in 2000 to about $28 billion in assets when we sold it in 2014. And we're doing it again. Battle Bank, we call it Battle Bank because we're battling for better banking. We're not going to have 15 US dollar deposit products. We're going to have one high yield money market account. If you want to get paid on your checking account balances, come to Battle Bank. Don't leave your money to bank where they don't pay you. If you want to save outside the US dollar, if you want to save in Canadian dollars or euro or yen or renminbi, 18 different world currencies, you can do that in federally insured CDs at Battle Bank. Daryl, if you believe that your IRA is your IRA, if you don't want your retirement to be merely a receptacle for mutual funds and other products of the big banks and brokerage firms, you open IRA at Battle Bank and your IRA can buy a duplex or a triplex. It can invest in a franchise. It can invest in private credit. Your IRA becomes your IRA. And by the way, if you buy a duplex or triplex, you might want to talk to us about writing a first mortgage on it. We'd love to have that discussion with you. Finally, on the lending side, if you believe in precious metals, there's no other bank in the United States that seems to believe that gold is good collateral. But I do. So people who have physical precious metals, gold, silver, platinum, and palladium in segregated accounts can come to Battle Bank and establish a margin account using that gold or silver as collateral. You don't have to borrow against it if you don't want to, but you can have access to the credit. Let's say that you own a bunch of gold or silver and the opportunity to buy a duplex, which you would fix up, comes about. You need the down payment. You don't want to sell your gold and silver. You can borrow against that gold and silver, refinancing later. And that gold and silver gives you access to the credit that would otherwise be tied up in the investment. So if you're uncomfortable with your current bank for any reason at all, go to battlebank.com, get on the waiting list, join 13,000 other people in the battle for better banking.
Yeah, that's just a very savvy move with the gold and being able to borrow against your precious metals and all of the other benefits too. But I'm super excited for Battle Bank and everything.
Thank you.
Well, Rick, I appreciate you for coming on again and everything. Looking forward to seeing you at the symposium. Love to have you on before then. We have about a couple months left. I'll check in with Callie to see if you have any availability. But thank you for coming on, and everyone that are watching this. I hope that you take heed to just the wisdom and the advice that you have been given from Rick Rule, the man himself. And Rick, thank you for coming back.
Well, thank you for the opportunity to talk to your audience. It's important to me to be part of the process where average American people learn the basics of the economy and learn the basics of household finance. Generating value for others, generating income, an income which you don't live beyond, generating savings, and then using the savings for your own future rather than entrusting your savings to the government, who is sure to wreck your future.
Yeah, that is true. That is true. Well, thank you, Rick.
Thank you.